Hey YouTube, so in this video I wanted to go over the top 5 reasons why you might want to consider avoiding the S Corp election. Now for those of you watching, say maybe, oh well, I talked to my CPA and they said you need the S Corp election because it helps you avoid paying federal self-employment tax on the net earnings from the business. Yes, that is partly true. You do get to run around those self-employment taxes, which you would otherwise be subject to if you were a disregarded entity or perhaps a partnership. But that's not the end-all be-all. There might be other considerations here which mean you should not be filing that S Corp election, and I want to go through what I think is the top 5. So number 1, to start off, limitation on who is an eligible shareholder. Right? So in an S Corp, you can have only 100 owners, 100 shareholders, and every owner has to be not only a natural person, but it has to be a U.S. tax resident. Now, there are some exceptions for certain types of subchapter S trusts, but very rarely do we see those in practice. What more often happens than not is that you want to add a new owner or an investor and they are not a U.S. tax resident or they're not a natural person. So for example, if you started a company, you made an S election, and then you wanted to go to market and raise some venture capital, the VC funds are going to be structured as corporate entities, LLC partnerships, maybe limited partnerships. You cannot take their money as an equity investment because that would immediately terminate the S election. They're not going to invest with you. Okay, so S Corp ownership is limited to, again, 100 persons, and they have to be individuals, and they have to be U.S. tax residents. So again, if you're looking to add a new owner that's, let's say, not a U.S. citizen, they live and work full-time in Germany, they're a German citizen and German tax resident, if you add that person to the S Corp structure, it terminates the election. That is an ineligible shareholder. You do not want to do that. Okay, so that's the first one, limitation on who can be an owner. Number 2 is a big one, depending on the business model. So no basis in entity level debts and liabilities. Now, in a partnership, if we're looking at the Schedule K1, you'll notice that there are line items for recourse financing, qualified recourse financing, and then just pure recourse debts, right? So what do these mean effectively? When the partnership has debts, it has liabilities on its balance sheet, it can allocate those debts to the owners, and the owners can use those debts to add to their basis in the entity. Now, the reason why basis is important, because the higher your basis, the more losses you can deduct if they're being allocated to you, and the more cash you can take out of the company without having to recognize any kind of gain on the cash distribution. Now that's important because in an S Corp context, you don't get to add those debts to your basis, right? So on a K1, you'll notice that no debts are being allocated to an S Corp shareholder, and that's because they can't add them to their basis, right? So if you have a heavily leveraged company, you do not want to be structured as an S Corp. You want to be a partnership. Now, it's true that in an S Corp, you can allocate debts on the company balance sheet if you personally as a shareholder loan that money. So shareholders in an S Corp track 2 bases. They track their stock basis, right? The amount of cash that they're actually putting in and how it's being and how their income or loss is being allocated. And then they track debt basis. So if you're a shareholder and you contribute cash to the corporation in the form of a loan, that contribution by you adds to your debt basis, right? But of course, that's got to be debt that you provide to the company. It can't be third-party debt. So if the company goes out and borrows money from a bank, those liabilities are not allocated to you as a shareholder. So that's very, very important, is you get no basis in third-party debts. The third big one is the gain on distribution of assets. Okay, so in a partnership context, if you have property, let's say a piece of real estate, and it's appreciated in value, you can actually transfer that property out, so distribute it out to an owner, and there's no gain or loss recognition immediately on the event. It's a non-taxable event for the most part. Now that's important because if you're just moving property from an entity to yourself, you don't want to record any kind of phantom gain, you still own it. In an S Corp, you're not afforded that luxury. If you have an S corporation that owns real estate and it transfers property out to you as the owner, that is a taxable event. So the corp has to basically treat it as if it was sold to a third party. You recognize gain or loss on the distribution and you're recording income, right? Not ideal if you're just moving it from an entity that you own, wholly own, let's say, and then you're just moving it to your personal name, or you want to move it to, let's say, a separate entity for different reasons. The very movement of that property out of the S corporation is going to be a taxable event. Not great, right? Okay, so for number 4, no disproportionate allocations of income, expense, or cash distributions. So what does this mean? When you have an S corporation, everything that's earned within the company, including the amount of cash that's being distributed to the owners, has to be distributed in proportion to what your ownership percentage is the company. So if we have a company, I own 90%, my brother owns 10%, whatever the company does, all the income and expense, cash distributions that go to the owner, it's got to be allocated 90-10. There's no system where we can own different class shares that have different allocations depending on whatever circumstances. None of that flies. If there's any disproportionate allocations, it terminates the S election because you've effectively created a new type of class of shares, which is not allowed. In practice, I see this most frequently happen with cash distributions. So the S Corp might allocate everything according to ownership percentage when it comes to like income. So if we're looking at line 1, ordinary income on that K1, that is allocated evenly across all the owners, so there's no issue there. But you might have one owner that takes more cash distributions during the year than everybody else in proportion to what their ownership percentage is. And it's that event that can trigger this termination of the S election. So if we go back to the same example, let's say I own 90, my brother owns 10, and the company distributed $100 during the year. If I took 50 and my brother took 50, that's disproportionate. I should have been allocated $90 in cash dividends. He should have been getting 10, but he took 50, I only took 50, done. We've terminated the election at that point. Now you can get creative with maybe, some of it's a shareholder loan or some type of advance, but in principle, if that occurs, you've had a termination of the S election. And that's different than in a partnership context where you can pretty much allocate things however much you want. As long as they're accurately reflected on the K1s, you can have certain side pocket investments where one partner puts in money and they get allocated all the income from that investment. A lot of private equity funds and hedge funds are structured where the GP will earn an incentive allocation. That's a disproportionate allocation, right? Because the GP might only own 1% of the company, but then they're magically being allocated all this income as their performance fee. That's permissible in a partnership context, but not in an S Corp context, so you can't do that. And then lastly, number 5, no step up in basis on the transfer of the stock. So when a shareholder passes away and the stock is transferred from their personal name into their estate and then ultimately the beneficiaries, the stock itself, the outside basis, gets a step up in basis because it's being included in their estate. That's fine. But the problem with that is when you have a step up in basis on the outside, but there's no step up inside, it creates a situation where the company could effectively sell the assets inside the company and you're almost recording kind of phantom gain because you've already recognized this increase on the outside. And so in a partnership context, the best way to fix this, whether there's a transfer on death or a sale, is you can make what's called a 754 election where the partnership increases the basis of the assets that it holds and it can now depreciate those assets all over again. And if it sells them, it gets a step up in basis on the assets, which is ideal. That's what you want. In an S Corp context, you don't get that, right? All you get is a step up in basis on the outside of the stock, There's no increase in basis on the inside for the company, so it can create this problem where the person that inherits the stock is in a bit of a bind because they have outside basis that's significantly higher than the inside basis of the assets. So if there's a sale of the assets and that new owner is basically being allocated income that he's already arguably recognized, right, on the step up of the stock because it was included in the decedent's estate. So yeah, so those are my top 5. There's frankly a number of other reasons, but these are the big ones that I see time and time again. Mostly they come up with estate planning. When I talk to an owner and they're thinking about, oh, maybe the S election is good for me, and it's like, well, what are you going to do with the company? What's your succession planning? Do you want to move some of the stock into separate entities like a family limited partnership so you can set up trusts for your kids, all these kind of things? You're incredibly limited if you have a company that's operating as an S Corp. Absolutely. The partnership structure is the most flexible, the most easy to kind of move the pieces around. Yeah, you might get burned with the self-employment tax issue if you're generating a lot of income in it, but for a lot of individuals, that additional hit on the self-employment tax is not worth being restricted for these 5 reasons and a bunch of other reasons as well. So that covers it. That covers everything I wanted to talk about. Thank you so much for watching. I hope it was helpful. If you have any questions, please leave me a comment on the video. Happy to answer them. And of course, if you can give the video a like, I really appreciate it. And subscribe to the channel if you aren't already. And I hope to see you again soon. Thank you.